Welcome back to Principles of Economics with Professor Klein. The topic of today's video, fiscal policy. So there are two tools in our fiscal policy tool bag, okay? And so again, as we think about fiscal policy, the idea here is to try to use the opposite policy according to whatever gap we are facing. So for instance, if we are facing a recession, then we want to implement expansionary policy. And so expansionary policy, we're going to look at our tools here in just a moment, is designed to shift aggregate demand to the right. We're trying to make this number larger. So as we consider aggregate demand, consumption, investment, government spending, and net exports all added together give us our aggregate demand, just like it did GDP. So when we look at our two tools in our fiscal policy toolbox, we're going to see that the first one is government spending. Okay, and so government spending, we can see that this is going to change aggregate demand because it's right here, right? So government spending is very direct. It's the most direct way to enact fiscal policy when we're considering these. The second tool is taxes. And so when we talk about taxes, just think about them in total, right? We're not going to look at the individual decisions that go into eliminating a tax bracket or adding a tax bracket. We're just thinking the overall total impact to both the consumer and business person, so consumption and investment together. Right? And so when we look at taxes, this is indirect because as you see, it's not here in our aggregate demand formula. So how does it impact our behavior? Well, what's going to happen is if we have fewer taxes to pay, right, then we would expect that we have more money available to us and therefore we expect our consumption to rise. So this is more indirect, and we're going to use it in an opposing manner than however we're using government spending. So if we are facing a recession and we are trying to enact then the contradiction, the expansionary policy, then what we would want to do is to increase government spending, right, and decrease taxes. Okay. As we decrease taxes, depending on how that effect is actually implemented, if it's in personal income taxes, then we would expect an increase in consumption. If it's done to business taxes, then or on buying a brand new home, then we might expect there to be an increase in investment, right? So this is expansionary policy. And here's the other thing, we can do either or. We can do a little bit of additional government spending and cutting taxes, right? Or we can focus on one or the other. These two often happen at the same time. Now, what happens as a result to our budget, right? The government budget, well, in order to have a balanced budget, that would mean that our tax revenue, right, total tax revenue to the government is equal to the amount of government spending. Or put another way, taxes minus government spending, there would be nothing left over. So when we look at if we implement expansionary policy and we see that our government spending is going up, but our tax revenue is falling, right? Then what's going to happen to the government's budget? Well, they're going to run a deficit, right? And a deficit refers to how much in one particular year or sometimes per quarter, right? So a deficit means in 1 year. So what's the difference between a deficit and debt? Debt is the accumulation of all past deficits, right? So if you run a deficit of $1 trillion in 2019, then that would add to the overall national debt, which is what occurred. right? So this is how we enact expansionary policy, right? And so how much will depend on other assumptions in our model, such as the marginal propensity to consume. All right, so now let's imagine that we don't have a recession, but instead we have an expansion, right? What does fiscal policy tell us? Well, it tells us that if we are facing an expansion, we do the opposite type of policy. So if we are in an expansion, we never ever call things recessionary policy. That's not popular. So instead we call it contractionary policy. And so when we're enacting contractionary policy, this is designed to shift aggregate demand left, right? So this is trying to get rid of any inflationary or expansionary gaps. And so when we're trying to shift aggregate demand to the left, well, we're trying to decrease this overall number. So since government spending is there and it's direct, this means that we would decrease government spending, right? Or if we want to leave it as it is or do both, then instead we could look at taxes. Well, if we want this number to be smaller, right, then we want less consumption, less investment, and so that would correspond to an increase in the amount of taxes collected, right? And so that would cause a decrease to consumption or a decrease to investment, depending upon how the taxes were enacted or adjusted, right? And so what is the result then, looking at the government budget, right? Well, if we enact contractionary policy, and if government spending, right, if government spending is now falling and tax revenue is increasing, there are two possible outcomes. What we're hoping for is a budget surplus, right? That's when taxes are actually greater than government spending. Now, this hasn't happened in a while. And so what has been happening as we enact sometimes contractionary policy is simply a smaller deficit. But that's not really the intent. If we look at Keynesian and the idea of being, of intervening into the market and using fiscal policy, it's not an either or situation, right? It's not, well, you can either implement Keynesian when we're expansionary or when we're contractionary. If you're going to be an interventionist, then in order to have a balanced budget, in order to not have a blooming debt, right, then you have to do the opposing policy. And so this is what has not been happening. This is what economics says we should do, right? Here's the normative statement. Here's what should happen, but this is not what has been happening. So we did have a budget surplus in 2004. And what's interesting, right, because if you think about what the government does, it's not in their nature to run continuous surpluses, right? Because if you do have a government that continues to have a surplus year after year, which is not what any government really does, then the question is, why are you collecting so much of my taxes? All you're doing is keeping it, right? So governments are intended to be nonprofit. There shouldn't be any profit. So we don't really want them to have a continuous budget surplus, but we also shouldn't expect to have a continuous budget deficit year after year, adding to an accumulated debt, right? And so this is what we're not seeing happen when we actually implement Keynesian policy. All right, so fiscal policy, two tools, government spending and or taxes. And remember that we would enact these in opposing directions based upon what we are trying to achieve. Hope that helped. See you next time.